we think the stock has really become decoupled from underlying fundamentals, and we see growing risks surrounding the story. Phil's exactly right about the automotive regulatory credits. The $428 million was more than double the average on that line item over the last 4 quarters. That's really where they beat, and that's where they posted a GAAP profit for the quarter, was because of those credits. But, if you look at the release, their free cash flow was down 32% year over year. Their quarterly CapEx was actually the highest level in 2 years, and that's because they started building the new factory in Germany, of course, and the new factory near Austin, Texas, will follow. So they're entering a major spending cycle, and that's why we've become more cautious on the story. Unlike 2 or 3 quarters ago when they were coming out of the major spending cycle, having completed the plant in China, they're entering a major cycle now, and we think of the free cash flow is really going to be depressed by all the spending that will be occurring over the next several quarters.
Garrett, and Phil can weigh in on this as well. Explain to the audience how these credits work, just so everybody understands what we're talking about, and to the degree that there's, I don't want to say a controversy around it, but to the degree that some investors are going to look at this and say, you know what, this is not selling cars. And
sure.
more importantly, how sustainable selling those credits over the long term will be.
Sure, it is sustainable. These are government credits that Tesla receives essentially for producing zero pollution, no emissions vehicles, and they can sell those credits to other automakers who are not producing the volumes of zero emission electric vehicles that Tesla is producing. So that's how that works. It's very difficult to model that line item because it can vary so much from quarter to quarter. And that's, the average over the last 4 quarters was $183 million. Here they did $428 million. So that's why you're seeing, over the last 4 quarters, that's a big reason why you've seen these beats relative to consensus, and was the driver of the beat for the second quarter.
But Garrett, the other question I had that goes back to what Phil was talking about, if they do get included in the S&P, almost by default, that's going to push the stock higher, at least in the short term, no?
So our issue with that is there's been a lot of buying in recent weeks leading up to this, really ever since the second quarter production and deliveries report came out in early July. So there's been a lot of money flowing into the stock. You can see the data from Robinhood. A lot of retail investors, a lot of funds have been buying it in anticipation of this. Essentially, these investors want to sell to those index funds, which would then have to buy the stock in order to add it. But we do think it will be added. Tesla, the market cap, is far and away the largest company that hasn't been in the S&P 500. The next largest was Facebook, but we think it will be added later this year, and so that's what a lot of investors have been playing, and that's a big reason why we think the stock has really become decoupled from underlying fundamentals, and why we lowered our rating to sell on Friday.